Hey everyone, welcome back to the Bitcoin Layer. I'm Nick Bhatia, and today we have a special guest here to talk about the FTX and Alameda saga. We have Lucas Nuzzi. He is the head of research and development at CoinMetrics. Lucas, thank you so much for joining us.
Thanks for having me, Nick. Pleasure to be here.
Absolutely. So you came out with some really excellent analysis looking at the on-chain transactions within this whole FTX Alameda research drama that we've experienced here in the last few weeks. So maybe you can give our audience an overview. What have you discovered and what are your principal findings? And then we can unpack it.
Yeah, sounds good. We've been covering FTX for quite some time now as a company at CoinMetrics, both on the market data side, looking at markets that are trading on FTX, collecting all of that data, as well as their activity on chain. We were surprised when the liquidity issues that were emerging on the Alameda side hit the news, and coupled with the CoinDesk article around their potential insolvency and this how FTT the token was centered in their balance sheets. So we set out to investigate their activities on chain and really try to paint a full picture of FTX's operations, especially within Ethereum, as well as their relationship with Alameda. So we looked at their wallets historically, all of the transactions that they've received and sent, which is a pretty big, endeavor when it comes to understanding the flows. And the picture that emerged was very different than what was being advertised by SBF and kind of the official story, even perpetrated by the media, that this was really a result of one bad trade and that there was a bug in their accounting software. There were multiple versions of the story that really didn't add up when you looked at the on-chain activity. In reality, it does seem like the funds that once belonged to FTX users were slowly being allocated into Alameda Research as the market was contracting. That trend accelerated in Q4 of last year. And our hypothesis is that they were directionally wrong in Q4 of last year, but the funds were likely moved to Alameda Research over the course of many, many months, and not just as a result of one bad trade.
Okay, so very interesting. Now, I want to take one quick step back and give people an understanding. What does CoinMetrics do as a firm? Who are your clients? What type of data you provide? And then just give everyone a really brief overview as to why we're looking at on-chain data to try to understand the story and vet whether or not SBF is telling the truth about fraud and funds moving around the place. Why should we care about on-chain data? Why does it matter here so much?
Yeah, so CoinMetrics, we've been around since 2017. We started as an open source project with a very simple goal. We wanted to make the activity that's happening in these blockchains more transparent, easier to reason about. And we started at the time when there wasn't a ton of analytics on Bitcoin, even on nascent protocols, which made the space perhaps over indexed on some protocols that were super experimental and claimed to do things that when you looked on chain weren't really adding up and true. So our mission initially was to enable anyone to answer very simple questions. How many transactions happened in Bitcoin yesterday? How many transactions happened in Ethereum yesterday? What is the on-chain volume of Bitcoin and Ethereum? So to do that, we run nodes. We run multiple nodes, multiple clients across various different blockchains. We build these exporters that enables us to source the data from the node and reason about it in a form of metrics, in a form of normalized data. Our clients are institutions, traditional financial institutions that are not running nodes themselves, but they want this data normalization layer that enables them to reason about the value proposition of each one of these blockchains. And ultimately, on-chain data is important because it enables you to test hypotheses with an unprecedented level of transparency, right? If you're claiming that your blockchain is hyper scalable, but in reality, there's just one entity that's doing 90% of the transactions in that network, is it really being used by all of these people, right? If you're claiming that your blockchain is private, but through on-chain data, you can actually identify users and it's not, you know, fully private. Is it really fair to claim that your blockchain is private? So the beauty of on-chain data is effectively that it enables you to test these hypotheses and get to the bottom of what is real and what is potentially marketing.
And so we know Bitcoin is not a truly anonymous system. It's pseudonymous, which means that we can see the data. We don't always know who, but with some legwork we do. So can you explain to us about on-chain data labeling? How, before we get into FTX and Alameda, what is your process like for labeling balances that you see on chain as this is an FTX wallet? What is that process like?
Yeah, so there are multiple approaches that you can take to label an on-chain address. Some are more robust than others. Our general approach is to be simplistic with our labeling. So we've been doing on-chain flows into and out of exchanges, for example, which is basically understanding the funds that are being sent to a crypto asset exchange and funds that are being withdrawn from the exchange. And for that, we scrape several different sources of data, such as their support forums, folks saying, "Hey, my transaction is not settling just yet," and they actually add a TX ID that we can go and validate. Um, we've done multiple types of clustering heuristics, and clustering is just basically a methodology where you, on the basis of the behavior of certain addresses, you can determine which addresses belong to an existing group of addresses and which addresses are brand new and might belong to a brand new user. I would say that clustering is somewhat dangerous to overemphasize because there's this full spectrum of methodologies to assign an identity to an on-chain entity. Um, I'm a privacy advocate. We are very much centered on privacy at CoinMetrics. Uh, we draw the line when it comes to these exchanges that take custody of user funds. We do see those entities as the ones that you really need to scrutinize. There's been this culture now of sharing addresses, which we've been tracking for a real long time. It's not the first time that exchanges go through this process of sharing addresses, but for exchanges specifically, it's a lot easier because their addresses have a certain pattern when it comes to withdrawals and deposits of various different users, as well as their willingness to share addresses too. A lot of exchanges have historically shared addresses. Some exchanges, such as BitMEX, they use vanity addresses. Their addresses actually have an identifier in the beginning that's been basically brute forced, so you can understand that this is a BitMEX address. Not all exchanges do that, but it is part of several techniques that we use to make that determination.
And quickly give us a sense as to how many entities you guys are tracking as CoinMetrics. So you say that you have an emphasis on privacy, which I'm understanding to mean you're not trying to assign balances to every which owner on the Bitcoin network, but rather these systemically important entities within cryptocurrency, you want to make sure that we are being transparent as CoinMetrics. We are being transparent with our users. We want to show them that, hey, this is X exchange, Y exchange, and Z exchange, and we know. So how many entities are you guys tracking approximately?
Yeah, and that's a very fair observation, right? We don't want to de-anonymize users. Users are actually a lot harder to de-anonymize than exchanges because their behaviors is fundamentally different than an exchange processing, thousands, sometimes hundreds of thousands of withdrawals and deposits in one day. So we're tracking, I would say, all major exchanges at this point. We have been tracking lenders as well, and really trying to get to the point of um, are their operations aligned with what they claim that they're doing? Um, are there any connections between these lenders that might be concerning? Really understanding the flow of funds between these entities is, I would say, systematically important to the ecosystem because you need to keep these entities accountable. Not only this data is useful in trying to understand market sentiments. If you see, for example, a lot of withdrawals from an exchange, it tends to correlate with uh, bullishness, right? Folks are putting their funds into cold storage and keeping it there. They don't envision having to sell in the short term, right? Unless like there's this uh, fundamental explanation as to why you would see that. Um, Whereas, not only this is valuable for the investment use case, it's also valuable for this type of investigation, right? If an exchange is engaging in behaviors that are not aligned with the community, being able to show them that we know as third parties observing the blockchain that they're engaging in potentially bad activities. It is, a very valuable tool that can keep them honest. So that's the perspective that we're taking. We want to keep these third parties honest, and we really welcome them if they're holding assets on behalf of users to openly share their addresses. And now we're going even beyond that and actually proving that they're effectively solvent and not operating, reserve banking.
So let's talk about the relationship now between FTX and Alameda. How were you able to see that what they claim is false? Basically, they're claiming that maybe some trades that had gone bad of late, as well as an accusation of an accounting backdoor that SBF might have just transferred billions from one bank account to another. So, and how many blockchains are you using to assess this data? Is it only Bitcoin, or were there other blockchains involved?
Yeah, we tried to, because of the breadth of data involved, we try to stay within Bitcoin and Ethereum and all ERC20 tokens that live within the Ethereum ecosystem. And we basically wanted to understand their activities on chain. There have been multiple addresses that have been associated with Alameda, also at varying degrees of confidence. Um, we sourced our tags from third-party sources such as Etherscan, and then validated it on chain. And some of the tags, they're not necessarily pointing to certainty as to that being Alameda, but some of the tags are objectively and deterministically Alamedas. Uh, the way that you would go about assigning this degree of confidence to a tag is very much focused on research. A lot of it is off-chain research. So, for example, Alameda was very active in the VC space, and a lot of these tokens that have pre-sales and sell a substantial percentage of their supply into the open market. They will disclose who was part of that round and how much they got. So if you can match that balance that was disclosed with an account on chain, you can see in that cap table who are the entities involved. And if those addresses subsequently do other things, then you can see, okay, this is Three Arrows Capital, this is Alameda Research. So doing this type of it's more like off-chain analysis, it really helps you increase the confidence level that, okay, we're really dealing with an address that likely belongs to Alameda. There's high likelihood that it belongs to Alameda. Um, And we did this not only for Alameda, but for FTX as well, right? We collected all these sources from third parties, some of the sources that we had internally, and we wanted to be careful with our claims and really look into the data historically and try to shed light on what happened. Um, and it really all started looking at a very suspicious transaction that came out of Alameda's wallet. It was an FTT transaction, and just for context, FTT was FTX's exchange token. Its utility, I don't want to say it's easily describable. You get trading discounts for holding the token, but we know now that FTX used this token as a form of collateral. They were the issuers of this token, so they retain a large percentage of that token's monetary base. And the transaction that we flagged was on September 28th, I believe, where Alameda, one of the addresses that were highly confident belonged to Alameda because of its participation in the FTT ICO from back in 2019. It sent billions of dollars worth of FTT back to FTX. And that was immediately after that address received these billions of dollars worth of FTT from the ICO contract that was basically implementing a vesting schedule. So they couldn't really spend those funds up until September of this year. The moment they were able to spend those funds and those tokens were released, they sent that back to FTX. And we found that to be highly suspicious because we know that the lines between the two entities have been always blurred, but the immediacy and the timing of it was highly suspicious. It was, I believe, a day after Sam Trabucco, the CEO of Alameda, had resigned. SBF on Twitter was saying that, oh, we're just doing some movements on chain, recycling our wallets, nothing to see here, which was also a lie because you can't really claim that the largest FTT transfer ever, which was that transfer, was mundane and something that you do repeatedly. So that really opened up the rabbit hole for us because we tried to understand if Alameda was in fact sending back billions of dollars worth of FTT to FTX, why was that the case? And if you understand the nature of Alameda's fund historically, and you understand the level of exposure that it might have had to the contraction of the market in Q4, to all of these illiquid tokens that had massive devaluations in Q1 of this year, if you understand the relationship with cross-chain bridges, the picture of them being healthy and solvent and operational fund starts getting challenged, right? So the natural hypothesis that emerged when we looked deeper into this transaction is that FTX actually bailed out Alameda at some point. And that payment in FTT tokens was the repayment for part of that bailout. And it was between the ICO contract from FTT to Alameda Research, from Alameda Research back to FTX. And that really just opened up Pandora's box in terms of the areas that we were looking at. That was really the hook. And over the course of 2 weeks following the disclosure that we found this transaction, we spent a ton of time finding other things that were equally concerning.
Okay, so after after the transaction was uncovered, I want to go into that, but before, just so that we understand, the smart contract that released the ICO uh, allocated FTT tokens to Alameda that they then sent back to FTX, and what you're speculating is that that transaction was a repayment of money So we'll talk about, I want to ask you, how do we know that FTX was bailing out Alameda going back several months, maybe tied to the illiquidity of other crypto assets during Q1, Q2? And then, but before you answer that, how do we, or why were those ICO FTT tokens, why were those sitting on Alameda's balance sheet? What part did Alameda have in getting those FTT tokens? Did it have anything to do with them being locked up or not? Where did those come from in the first place?
Yeah, so these tokens are printed off thin air, right? So when FTX was just starting, they were very successful as market makers in the beginning of that whole Asia strategy because of Alameda research. Alameda precedes FTX, and it was central to the foundation of FTX. When FTX was founded, they wanted to follow a model that was very similar to Binance's. So they wanted to issue a token because they saw the success that Binance had with BNB when it comes to generating additional uh, sources of income by just reselling this token to your participants, right? So they replicated this model, and because of how foundational Alameda was to bootstrapping FTX in its very early stages, what ended up happening was Alameda received a large allocation of FTT tokens as founding partner of FTX. These tokens were locked because they also brought in other investors that likely pressed them to add these vesting schedules to those tokens. So those tokens, although they were automatically going to be disbursed to Alameda in September of this year, they were not necessarily part of Alameda's balance sheets. It took until September of this year for them to be unlocked and for that cliff to hit to the point where Alameda could, in fact, spend those tokens. And this also plays a critical role in the story because if Alameda did blow up, and started losing a substantial amount of money starting Q4 of last year, had they gone bankrupt, the fund would get liquidated. They will look at everything that fund owns and they will liquidate that in the open market. And what that means is that FTT that Alameda was about to receive in September would also get liquidated. And given its quantity, it would drastically impact the value of FTT token. If FTX was also using FTT for other nefarious purposes, like such as using it as a collateral for loans, that would also impact their potential liquidation thresholds, and it would just have been a nightmare for FTX. So they might have found themselves in a position where they had no other option but to bail out Alameda, with the guarantee that Alameda, once those tokens vested, would then send those tokens back to FTX. But the fact that there was a vesting schedule in September of this year, tokens that were going to be released, and had Alameda actually, disbanded and liquidated, those would be sold in the open markets. It really adds credit to this hypothesis that a bailout did occur, and it had to occur for the sake of FTX itself.
Okay, so now I think we have a few things cleared. Now let's get to the more nefarious side of things. So let's assume that Alameda had trades that blew up starting in Q4 21 when the market started to turn south as the Fed started to signal we're about to tighten monetary policy, stock started to dip, and risk went off. So let's assume they lost a bunch of money on bad trades. Now let's go back to the on-chain world. Was FTX depleting customer funds and and channeling them to Alameda to either cover up losses or to get new capital to try to make money to cover up or to make up for all the losses that it had experienced. What what certainty do we have that FTX was actually sending money to Alameda and that money being actual customer funds?
Yeah, so in order to better understand the dynamic, what we did was we looked at every single transaction going out of FTX and into Alameda, and looking at every single transaction going into Alameda and out of Alameda. So we tracked their addresses historically, and we wanted to try to validate this hypothesis that funds were siphoned over the course of time, and starting really in Q1 of last year, because what we saw was that there were billions of dollars being sent on a monthly basis in stablecoins and liquid crypto assets from FTX and into Alameda. That trend really accelerated in Q4 of last year as markets were contracting. The majority of flows that came out from Alameda and into, from FTX and into Alameda, the majority of those outflows took place in Q4 of last year. Given what we know about the size of their operations, the scale of these outflows is just astronomical. We're talking about multiple $billion being sent on a monthly basis and not returning. This unidirectionality of funds coming out of the FTX addresses that we know and into Alameda and not returning to us was a huge red flag. And not only did the funds, the majority of them were sent in Q4 of last year and Q1 of this year, when we know a lot of these funds started blowing up because they were long, the markets contracted quite considerably, several projects blew up. Not only do we know that they were impacted by this, but the nature of their investment strategy also changed. They stopped using as much liquid crypto assets, and they started focusing predominantly on more illiquid crypto assets. They started interacting with cross-chain bridges more actively. They started the liquid on the liquidity spectrum. When you think about the outflows of funds in their portfolio, they started going to a lot more illiquid assets, part of the Solana ecosystem, part of recently launched VC tokens. So if they were in fact doing what they claim to be doing, a market neutral fund, you would see them systematically deploying more liquid assets over the course of time. And that's not what you see on chain. You see these massive outflows from Alameda or from FTX into Alameda, and then out of Alameda into other exchanges, into DeFi, even cross-chain bridges. They were heavy users of cross-chain bridges, and those funds did not return to FTX. Over the course of 2022, the nature of the operations of those wallets turns 100% illiquid in terms of the predominant strategy that they used, where they were mostly using these ERC20 tokens, transferring them around, bootstrapping, ecosystems that were new, part of Solana ecosystem. And what that tells us and adds credence to the hypothesis is that that's when they actually lost user funds. And the scale of funds involved signals that Alameda could not have perpetuated like these massive outflows just by itself. FTX had actually to contribute to it in the form of nothing but user funds.
Wow. So what you guys discovered is that the money that left FTX went to Alameda, went into projects that failed, and you were never able to see the money return until that late September occurrence when money got unlocked, and then you saw a return of FTT. But if that return of FTT, the price of the underlying fell, then it wouldn't have made enough difference to the FTX balance sheet in terms of being able to cover up all the customer funds that have left. So, are you able to say that through this process of FTX sending money to highly liquid assets to Alameda in Q4 21 and Q1 22, was that the siphoning of customer funds? Was the original losses that started all of this fraud, does it trace back to Q4 21, long before Terra Luna, 3AC, and other contagion? Is that what you're concluding, and is that the thesis here?
Yeah, given the scale of funds involved, I'm talking over $5 billion being sent out on a monthly basis. Um, it's very difficult to explain where, other than Alameda or other than FTX's user funds, these outflows would have come from. The scale involved is just so massive that there's, in our opinion, no other explanation but the one that they've actually siphoned user funds in Q4, and using accounting tricks, were able to effectively offset those outflows on the basis of their own positions of FTT and other liquid assets. Mark to market accounting became the norm for them, right? So even today, when you see SPF claiming that, oh, we were solvent, FTX US was solvent, we held, I believe at some point he mentioned $14 billion in assets. The majority of those assets were illiquid, and their biggest position was in fact FTT. Once all those funds were sent out, they were only left with FTT tokens and all these illiquid tokens. So user funds disappeared. They ended up with this massive FTT bag. The only logical explanation, even looking at these flows, is that something happened with Alameda. They were able to replenish Alameda by siphoning user funds in the form of liquid crypto assets. Alameda sent back FTT. The whole basis of their existence then became propping up FTT. And we found evidence that there was an entity in Binance's FTT USDT markets, very incentivized not to let FTT prices go down, providing pretty substantial price floors for FTT, because after they've likely lost the majority of user funds in Q4 and Q1, FTT became central to them. And I think their whole strategy was to stay afloat, become as ingrained with the US regulatory class as possible, really perpetuate this image that they are a responsible institution and they are, managing their funds appropriately, so that they, on the side, could offload that FTT into investors, into their users. And if there was not a bank run taking place, they would have been able to perpetuate this for God knows how long. Had CZ not really called their bluff on being solvent, who knows what would have happened. I'm against putting CZ on a pedestal in this situation, because it was also to his benefit to unwind his FTT position and crash that market. But at the same time, that was really what got us here. What really revealed the extent to which they were being irresponsible and they were basically not solvent anymore.
So then let's talk about a couple things here. I'll present both questions. Number one, is there any on-chain evidence that Binance was involved in an attack here and that's aside from CZ tweeting about the potential, let's just say, wanting to sell FTT and dump it on the market because we don't want to hold that position anymore. We're a little worried. So he definitely moved the market with these tweets, and we see what happened after. Is there any on-chain evidence that Binance was involved in anything to do with FTT? I know you had mentioned propping up the market a few minutes ago. And then the second question is, where did all the Bitcoin go? So people on FTX held paper Bitcoin, meaning when you log into FTX, say you're a hedge fund like Ikigai, for example. Ikigai is, admitted that they had a massive amount of exposure, means they had balances of Bitcoin on that exchange or whatever coins. Let's just say Bitcoin. So they log into their screen and they see we have 400 Bitcoin on this exchange. Okay. Now, that we, from certain bankruptcy documents that we've seen, FTX didn't have any Bitcoin. They had 1 point something Bitcoin. So they literally had no Bitcoin, but people in their accounts had Bitcoin. So was that Bitcoin sent from FTX out to Alameda over the course of the last year? And that's where, and then it was put onto exchanges, traded, and gambled away and lost. So I guess the two questions there are, was it all paper Bitcoin? Where did that Bitcoin go? And then what did Binance have to do with this fall other than CZ's tweets?
Yeah, in terms of where did the Bitcoin go? I mean, it's very likely that a lot of it went into Binance, right? If you look at Alameda's strategy, they made ample use of coin margin futures. They made ample use of stablecoin margin futures. And for these products, you get the best prices the more liquid your collateral type is. So it would only make sense that the Bitcoin that once belonged to FTX users, um, or maybe was exchanged for another asset like a stablecoin or other assets, the most liquid assets were the first ones to go, right? Because you get the best volume prices using more liquid crypto assets. So when we think through their strategy, the relationships between Alameda's addresses and even other exchanges, it's very likely that Alameda was not only using their own accounts within FTX to trade, they were also heavily using other venues. And if they in fact lost a substantial amount of funds in these other venues, it was likely in the form of highly liquid collateral, you know, Bitcoin, stable coins, Ether, and that's potentially not only how they might have lost those liquid crypto assets, but also imagine operating an exchange and doing market surveillance, which we know a lot of these exchanges do, right? They want to track for things like wash trading, which is a form of market manipulation. If you see Alameda lose a substantial amount of Bitcoins because of a bad trade, and not only do that, but do that consistently in Q4 and Q1, it would, if you're actually doing that, which we know, Binance is doing that, there's a level of trade surveillance in every single major exchange. I guarantee you that, because we actually track the markets on those exchanges as well by connecting to their APIs and kind of looking at potential wash trading. That might have provided folks that were operating these exchanges evidence, or at least given them a hypothesis that, hold on, Alameda lost all this money. We know this is what they have under management. These are the assets that they have under management. There's a big mismatch there, right? So there's something that we've discussed internally at CoinMetrics multiple times, which is the level of intel that any third party might have had even before we broke kind of the on-chain parts of the story. Um, we think that these exchanges, if they have entities and people within these exchanges that are focusing on monitoring their counterparties, they could have seen on chain that Alameda had this really unhealthy relationship with FTX, where it was basically just receiving money from FTX and not sending it back. And they could also see that Alameda, in their own venues, in those markets, was actually losing a lot of that money. Um, at that point, if you're Binance and you've connected the dots and you have a pretty substantial FTT position, and you have also the opportunity to bring down one of your biggest, if not the biggest competitor, that was the perfect opportunity to do so. We can't really objectively see on chain Binance's full picture of activity because their own FTT balance, as well as their users, the users of Binance that held FTT within Binance, are all within the same wallet, right? Binance reuses wallets quite aggressively. What we could see in that specific event, where there was an entity that was defending the price of FTT quite drastically, was that um, there was a price floor the moment the CoinDesk article came out, really trying to protect the price of FTT. There were Binance after the release uh, of that story on CoinDesk about FTX's balance sheets. Binance actually led price discovery across all markets, meaning prices were going up on Binance, and other exchanges were following suit because of arbitrage traders. And we saw some pretty big orders trying to prop prices up. It got to a point where when CZ tweeted, that trend uh, shifted. There was more aggressive attempts at providing price floors and preventing the price from going down. And if you're Binance, and imagine you have on-chain expertise in house, that Alameda has had this really unhealthy relationship with FTX. Like you might be trading them even in OTC desks and getting maybe an even better picture than third parties like CoinMetrics has on their activities. You're also seeing them lose a lot of money in your own products, and now you're seeing them trying to defend FTT uh, in a massive scale, right? Actually trying to prop that market up so that the potential price impact of this article was countered by a rally in FTT. That gives you three very strong pieces of evidence that there's something very wrong, right? So that might have been what was happening within Binance. We did see a massive sell order flow that coincided with the tweets, and by that point, the price trend had shifted, prices collapsed, and the entity that was trying to prop up prices in that market effectively gave up because they probably had other things to worry about because they're probably Alameda using user funds in order to prop up that market. That's all. Our hypothesis is still highly speculative, but you can really see that progression of events fit into what you see not only on the market side but also on the on-chain side, as limited as that might be for Binance's own operations.
And yeah, so what you're saying here is that even though Binance might have and probably knew that there was something seriously wrong here in maybe even the months before, because the fact that they have their own little on-chain team within that firm monitoring their competitors. The shit really didn't start to hit the fan until the CoinDesk article that exposed how much FTT was on the balance sheet of Alameda. So then I'll just ask you one last question here. In the last few months of FTX, let's say amidst all this basically insolvency, and they're trying to cover up the fact that they have lost customer funds through the sister hedge fund. If a person comes on to the platform and buys Bitcoin on FTX, let's say in October of this year, and FTX fills that order, was it possible that that Bitcoin didn't exist ever? It wasn't even sourced from the market? Is there anyway from an on-chain perspective to understand if there was demand for Bitcoin on the FTX platform? Did it ever actually hit the market? Is there any way to know that?
That's a fantastic question, and something that we're actually working this very moment, because that would be a clear indication of fraud, right? So we have their on-chain addresses for Bitcoin as well. Historically, they have held substantial amounts of Bitcoin. Um, but if the filings actually reflect the full extent to which they were not holding any Bitcoin, and their Bitcoin markets were as liquid and with the volume that we saw even a month ago, that is clear fraud, because those are not real Bitcoins. Those Bitcoins did not exist, never existed, and it would be extremely difficult for them to justify it. So that's exactly what we're trying to decipher right now. You can look into FTX markets and see uh, an implied collateral that they needed to have to match buyers and sellers at a specific scale. Our question is, does that implied collateral size matches with their on-chain balances? Based on these filings and based on some preliminary data, it does not seem to be the case, which points to this idea that those Bitcoins did not exist. Those are not real. They were completely fabricated, and that is fraud. If you're an exchange and you're offering an exchange of assets, you need to have the two assets in that pair. There's no way around it. So I find that to be interesting for two reasons, right? I think one, it really highlights the importance of holding your own Bitcoins, doing self-custody responsibly, uh, and also highlights the extent to which their activity wasn't as it's being portrayed. It wasn't just a mistake. There's actual evidence of fraud at a massive scale that prosecutors need to, basically validate, because if you look at the scale of their Bitcoin markets, it was a substantial market. It's one of the biggest Bitcoin markets in the world, and it was propped up by um, paper Bitcoin that did not exist. That is a massive development. Because those Bitcoins did not exist, uh, prices could not even see upward pressure, right? Because they didn't have to buy those Bitcoins to actually make that market, uh, which is incredibly deceptive. Something that's, as we progress with our research, we definitely want to zoom into. But there's a ton to decipher. It's definitely not the end of the FTX saga. And there are all these different corners that we're looking at right now to basically get to the full picture, both off-chain in terms of like these markets that are happening, these exchanges, as well as on-chain, looking at their activity over time.
Lucas Nuzzi, thank you so much for joining us, Head of Research and Development at CoinMetrics. We really appreciate your time, And I'm thrilled personally to hear that you guys will be looking into deeper into whether or not there was real Bitcoin on the other side of FTX's market making, especially in the last several months here. It could open up a new angle to just the extent of the fraud that was taking place. So before we leave, tell people where they can find you and give us an idea of where is the Justice Department? Where are the prosecutors? Are they talking to you? Do they have any track record of using on-chain data, using expertise like you guys are providing in order to bring criminals to justice?
You would hope so. We we hope that this, in fact, gets used to corroborate the fraud that FTX perpetuated. We'll see. I think everyone is incredibly disappointed with U.S. regulators right now, given that SBF spent Thanksgiving in his Bahamas penthouse when hundreds of thousands of users lost their funds. Right? It's infuriating. So we sure hope that our data sheds light on the extent to which this was in fact fraud and not just a bad trade. The As I mentioned, the research continues. We're still looking at all these different corners. We have a free newsletter that you can subscribe to. It's called State of the Network. If you go on coinmetrics.io and under research, you can see State of the Network and you can subscribe to that. Also follow me on Twitter. I'm Lucas Nuzzi, NUZZI on Twitter. I like writing threads about our findings and publicizing it. But we'll definitely keep the community posted when it comes to more bombastic findings. But it's very clear that that portion of the on-chain flows is just scratching the surface when it comes to understanding the extent to which this was a completely fraudulent operation.
Lucas, thank you so much for joining us. Go make sure to follow Lucas on Twitter. Sign up for his newsletter at coinmetrics.io. I'm Nick Bhatia. Go sign up for our newsletter as well at thebitcoinlayer.substack.com. That's where you get all of our research, analysis, and education. And thank you to our sponsor, Voltage, provider of industry-grade Lightning Network and Bitcoin infrastructure.